The US dollar shot to a two-decade high against the Japanese yen after the Bank of Japan pledged to buy endless amounts of bonds in a monetary policy response many investors are calling uber-dovish. That's driven down the value of the yen to the psychological barrier of 130 against the dollar, levels not seen since 2002. And the dollar isn't only strong against the yen, the euro also slid to a 5-year low against the greenback, bringing the losses for this month to 5%, its worst fall since early 2015. The slide adds to Europe's economic troubles, raising the cost of energy at a time when natural gas prices are soaring. For more on this now, let's bring in Susannah Streeter, who's a Hargreaves Landsdown investment analyst in Bristol. Many thanks for being with us this morning. Susannah, first of all, Japan. I mean, how sustainable is this uber-dovish, extremely dovish monetary policy at a time when inflation is also rising in Japan?
Well, I do think you are seeing some cracks appearing in this edifice that until now really has remained strong in terms of the opinion that a weaker yen is good for the economy because it boosts the value of overseas earnings and makes exports cheaper. But now we are facing the soaring inflation problems, hurting Japanese consumers as well. And of course, Japan has to import a good deal of energy, so energy costs are going up and inflation becoming a lot more problematic. And you have a number of voices coming out, including the Treasury Minister Suzuki, saying that normally a weak yen is neither good nor bad, but right now we are seeing a bad weak yen emerging because of what's been happening around the world and the pressures on prices. And so even though, yes, at the moment, the Bank of Japan is continuing with this dovish stance, I do think you're going to hear many more dissenting voices. We've heard, for example, from the boss of fast retailing company corporation, the owner of Uniqlo, saying actually right now, because many companies have to import raw materials to then manufacture goods, it means that their costs are going up dramatically, so something needs to be done.
Interesting, Susannah, a bad weak yen really, and across the pond as well, there's serious concerns that the euro might get to depths not seen since 2002 and even potentially decline below parity. If that were to happen, I mean, what would it mean for Europe?
Well, it's a similar situation, of course. It's going to hurt consumers more. It's going to hurt companies more. Companies will have to pass on the higher input costs to consumers via products, but at a time when actually consumer confidence is lower and consumers are more inclined to buy less, in fact, because they simply don't have as much money. It will make, again, exports more competitive, but you have to really weigh that up against the fact that imports, and of course you're highly reliant on energy imports, as we know right now with this huge row going on about whether or not a crude oil embargo should be slapped on Russia. So given it's so reliant on energy imports, it's going to make the cost of living and the cost of commerce squeeze even tighter. The problem that the European Central Bank have is that there are real concerns that the situation in Ukraine and the stance towards Russia, particularly if fewer energy supplies can be brought in, will hurt the economy. So that's why they're less inclined to take the aggressive path of rate hikes that we're seeing from the Federal Reserve, and that's really boosted the value of the dollar.
Absolutely. Energy costs really in the spotlight for investors. Susannah Streeter, many thanks for being with us today.